Banks don't lend money, they create it. Demystifying monetary and banking terminology. This is a paper I gave to the 7th Critical Finance Studies Conference in Copenhagen. And if you want to check out the slides, go to the address mentioned at the lower right-hand corner of this slide. Now, an overview of my presentation. I address 3 problems. One is the question of what a bank actually does when it lends money. We sort of know that it creates money, but how does that work exactly? In order to explain bank lending, we have before us 3 theories proposed by Richard Werner. And I want to ask which of them is true, or when exactly is it true. I should also inject here that citations given in brackets like here are all collected at the end in a long list. The third and last problem is that the very term lending and loans, they seem like mystifications when in fact banks create money. What is going on here? My presentation is structured in 3 parts. First, I explain how banks actually create money, and that is account money, of course, not the paper money like the guy in the illustration does. The second section deals with the 3 theories of bank lending, and I suggest that they fit 3 different monetary and banking systems, and each theory throws light on each system. And lastly, I point to some money and banking terms that need to be demystified, and I will advance a few hypotheses as to why they haven't been already. Okay, let's look at the question of what happens when a bank lends. Well, it creates money, but how does that happen exactly? Well, this was set forth very clearly in a paper written by 3 economists at the Bank of England called Money Creation in the Modern Economy, where they said banks do not act simply as intermediaries lending out deposits that savers place with them. This was amplified in a paper written shortly thereafter by economists at the Danish Central Bank, which was followed up by a press release by Hugo Frey Jensen, one of the governors of Danmarks Nationalbank, in which he quite clearly says banks create deposits and thus money when providing loans. In other words, when a bank provides a loan, it enters digits in the borrower's bank account, and they are the deposits, and when they're used in payment, they become money. Let's look at an example. I go to the bank to take out a loan of 800,000 kroner. This amount is entered into my bank account, my current account. It is a bank liability in the sense that this is money that the bank owes me and is willing to pay me. At the same time, a new account is opened in my name, a loan account, where the same amount, 800,000 kroner, is entered, but now with a minus in front of it. And this registers my debt to the bank, and it becomes a bank asset. So the bank has now created by book entry a liability for itself and an asset for itself. In a sense, they cancel out. What they call it is, they say the bank's balance has been extended by 800,000 kroner. And we notice that there has been no transfer of funds at all. No other account has yielded the 800,000 kroner that it went into mine. There has been no intermediation between any other depositors and me, the borrower. This is expressed by Michael Kumhoff, who's a senior research advisor with the Bank of England. He says this in a paper: whenever a bank makes a new loan to a non-bank customer X, it creates a new loan entry in the name of customer X on the asset side of its balance sheet. And that was my step 2 above. And it simultaneously creates a new and equal-sized deposit entry, also in the name of customer X, on the liability side of its balance sheet. That was my step 1 above. The bank therefore creates its own funding deposits in the act of lending. Now, let's take a closer look of this lending business. I'm suggesting here that if we add clearing, then we have a total picture of money creation. Now, when a loan has been made, the borrower spends it like I spent my 800,000 kroner purchasing an apartment. That is a payment, and it takes the form of a transfer to another person's account, the seller of that apartment. Now, we may well ask, doesn't that require the bank to cough up the money? Isn't this the point where the bank actually will have to find 800,000 kroner? And our answer is that, well, no, it doesn't really happen like that, because millions of payments are being affected that very same night in the national payment system, which in Denmark is run by nets. That kind of clearing matches all the different accounts paid out by the different banks against each other, and only the small net amounts are actually transacted. That's what a payment system does. It facilitates money creation. It enables the banks to extend a large number of loans without actually finding very much money in their own coffers. That's what we see in this picture from 1870, where about 60 clerks from different banks in New York bring their checks drawn on the other banks to a central clearinghouse where they deposit checks for the other banks in each of the boxes, and they walk around this entire table, completing the clearing in a matter of hours. This, of course, is done today electronically. Now, loans increase deposits. That's what we just seen. We make a loan, the bank increases the deposits in the borrower's account. And this increases the total money supply in the nation, because that money supply is simply cash plus whatever is in the deposit accounts of all account holders in the country. That's the total money supply. So when we add new digits, new money to these deposit accounts, we increase the money supply. That is what we mean by money creation. Likewise, when we start to make repayments on loans, then we have to find that money from our accounts, and we take them out of the deposit accounts, we deduct them from our current deposits, and we transfer that money to our loan accounts. That process decreases the amount of money in the deposit accounts, and that amounts to money destruction. What that means is that in good times, as we all know, banks are more than happy to lend, and they overlend, and they feed bubbles in fixed assets such as stock and real estate, and that drives the boom and bust roller coaster. So unchecked bank lending or money creation is a main course of the business cycle, and a very important process, not just something that, oh well, that happens in banks. It's a major macroeconomic driver that has wide-ranging consequences. But we don't really understand this fact because we are confused by the term lending. It's a strange terminology. If you look at the example of you lending your lawnmower to your neighbor, you may well ask, what lawnmower do you create in the act of lending it? And when you return the lawnmower, does it cease to exist, just as happens with money? It's very strange. Why has this term lending persisted when it so obviously is not lending? May it be to justify the charging of interest, because we know that savers must be compensated for the unavailability of their funds. Right. Could that be one reason? Well, let's look at the three theories of bank lending and see if that sheds some light on what's actually happening here. Let's look at the three theories of bank lending. What happens with money when banks lend it? Well, the first theory is the financial intermediation theory. It says that a bank gathers deposits from savers and lends them to borrowers. That's the familiar theory. We all know it. The second theory is the fractional reserve theory of banking, also well known from economics textbooks, especially American ones. The theory says that a bank retains a fraction, like 10%, of every deposit made in the bank, and it lends on the remainder, the last 90%. And banks do this again and again, and in that process expands the nation's money supply. Now, the third theory is the credit creation theory, It says that a bank creates new account money simply through bookkeeping by adding digits to customer accounts. No reserves are needed. Werner has a couple of studies, and this is one from 2014. He finds overwhelming evidence for theory number 3, relegating the 2 other theories to the trash heap of history. What I would like to argue here is that the 3 theories are suitable for 3 different banking systems, which are sort of ideal type banking systems, Weberian types, maybe not found in their pure forms, but very convenient to think about. Now let's look at the first theory. That's the intermediation theory, and I would suggest that this theory fits a warehouse bank. The theory is true when banks in the olden days accepted gold and valuables for safekeeping. The gold coins deposited with the bank were lent on with or without the depositor's knowledge. This theory has survived later developments in banking, and it remains the popular theory of banks. And what we would say here is that, well, it is true for that type of bank, which is historically a fairly rare type and hardly found today at all. The second theory is the fractional reserve theory, and I would suggest, well, it fits obviously a bank that has reserves. The theory was invented for a gold type banking system, and here deposit slips issued to people who deposited gold with the bank. These deposit slips start circulating as money or banknotes, and the bankers, the depositories, they write fake deposit slips and passing them off as loans to people who come to the bank or to the goldsmith to get gold. Instead, they get a deposit slip, and that works perfectly because they circulate as money in the economy already. So the reserves in that kind of system, well, they're the banks and nations' safeguards against bank runs, because at some point customers will realize, gee, these banks have issued more deposit slips or bank notes, that there is gold in their reserves. So they all want that gold and they run to the bank, and that's where we have the problem. Now, the term reserve really only makes sense here and not in the earlier warehouse bank, where there is no new money created, thus there is no need for reserves. So the fractional reserve theory, you may say, is an improvement over the previous warehouse banking theory, the intermediation theory, because here you actually have money being created on top of something else. And in the 17, 18, 1900s, this theory was a fair fit to empirical reality. That is, if we ignore account money, which is sort of hard to do, and which is why we really need to turn to the third theory, which fits the pure account money bank, the bank that has account money as the predominant form of money. The money does not have to be electronic. This worked in old-fashioned accounts kept in ledgers as well. The theory says that, well, a bank credits the borrower's account with a deposit and enters a corresponding asset that is the value of the loan on the other side of the ledger. In this sense, no funds have been transferred, and deposits are simply created from scratch. This theory is suitable for a banking and monetary system where all money is account money, where you don't have any gold or cash, and that is pretty much the situation we have today, where there is very little cash left in most monetary and banking systems. In the olden days, bookkeepers discovered that they could lend money by simply adding numbers to a borrower's account without honestly subtracting the same number from some other account. Why should they do that? They didn't have to do that. When many amounts are transferred between accounts, they tend to clear. And in this clearing of matching loans lies money creation. That's what we saw today, and that was what was discovered many hundreds of years ago in earlier account-based banking and money systems. As loans are not given as cash or gold today, this theory fits the current banking system very well. So if we evaluate the theories, the three theories together, we can conclude that they're suitable to historically different banking systems. And if we find that past economists seem somewhat confused about bank lending and money creation, and this is what we do, well, then there's maybe a good reason for that. Werner says this about Keynes. Keynes did little to enhance clarity in this debate, as it is possible to cite him in support of each of the three hypotheses through which he seems to have moved sequentially. And I would argue, well, that's not so strange, because British banks in 1925, when Keynes was thinking about these things, they were a combination of warehouse banks, gold reserve banks, and account money banks. So it would be difficult for him to sort himself and the banks out and decide between these three theories if he had indeed kept them clear in his mind, which he didn't. Today, we would say that theory number 3 holds. Our banking system is ever more account-based. But where you find the other banking systems, those other theories are fine. When banks today use theory 1 concepts, it is misleading and it is self-serving because it justifies the charging of interest. We know, in fact, that no lender forgoes the use of their money, but the banks pretend that they actually do, and that's why they're justified in charging the interest. When this theory is used today, it also hides the bank's enormous power to create money and control the money supply, because we believe that banks just lend other people's money when in fact they create money from scratch. And also, this theory portrays banks as humble servants of society's needs when in fact they're pursuing their own profits. An example of this, where theory 1 is used for public communication, we find in this statement from Finansrådets hjemmeside, which I render here in the original Danish, and here it is translated. It's the Danish Bankers Association website. They say, banks establish contact between those who want to borrow money and those who wish to save. The bank's unique role as money intermediators creates value by making it easier and cheaper to borrow and save. The banks channel the money in society to where it does the most good. A pretty story indeed. Now let's look at some terms from theory 1 that mystify needlessly. I list them on the left and I suggest some alternatives, more honest terms on the right. So the terms lending and loan, well, they're warehouse terms that conceal the fact that banks create money. We are led to believe that the money we borrow at the bank are simply other people's money. Why shouldn't we use the term create money so that when we go to the bank, we say to the bank officer, I'd like you to create £200,000 for a new home for us. Would you do that? That would be straight talk. Terms like loanable funds or funding, they suggest that lent money derives from funds, that somehow the bank finds the necessary funds before it can lend money to us. And the same goes here. Well, that is money creation, and we could argue that it's unethical to pretend otherwise. And we may even ask whether standards from truth in advertising don't apply here. Is it maybe even illegal to claim that you're doing one thing when in fact you're doing something else? Now, making a deposit is also somewhat misleading because nothing is deposited. It's all numbers. There is no gold and there's very rarely cash being deposited. Deposits are not things. What the bank does, it simply coordinates numbers. We could go to the bank and ask the officer, would you jiggle some numbers in my accounts? And that is essentially what we do at night in front of the computer when we log on to the bank's accounts, and we move numbers around between our accounts. That's what we do. Now, repayment of a loan. There really is no such a thing as repaying a loan, because you cannot repay freshly created money. That's an inappropriate term. It makes it sound as if the bank paid you and then you pay back the bank, when in fact what happens is that the money is simply destroyed. The bank created the money and then we destroy it again. So when you agree to a repayment schedule when you've taken a loan, what you could tell the bank officer, let me destroy £5,000 a month. Simply erase it from my account, will you? Well, then that would be the proper terminology. Now, the term the business cycle is very commonly used to indicate the whole boom-bust economy. And that sounds like something you do in the ordinary course of business, as if it is not preventable that the economy has to go up and down. Why don't we simply call it money bubbles or financial bubbles to underscore the money-created origins of this boom-bust roller coaster, and to indicate quite clearly that that's a design consequence and it can maybe be changed. Let's look at some possible reasons why there hasn't been a change in terminology from lending to the more honest money creation over the past centuries. Well, one reason is, of course, ignorance. That when early trading houses and merchants allowed customers to go into debt and still trade, that is essentially giving them a credit line or even giving them a loan, they didn't know they were creating money. They didn't have the macroeconomic perspectives that we have today, so they didn't realize what they were doing. There might have come a gradual awareness that they were doing some deception here, like the goldsmiths writing fake deposit slips. They must have known that something was wrong and it wasn't quite honest what they were doing. And that then slowly morphs into a deliberate silence for gain, we may well assume. Why call attention to a fraud by naming it so? Related to this is the traditional banker's responsibility to guard the public's trust. This notion that bankers must be very careful when they talk about money, because we need the public to trust us, otherwise they will do a run on the bank if they get a sense of that there is something not quite proper going on here. And especially central bankers are keen not to let on to the general public what's actually going on in banks. Now, when it comes to scholars, they also happen to be somewhat unaware of what's actually going on in banks. Money and banks are virtually absent from economics, and they have been so for the past 60, 80, 100 years. Money is often seen as a neutral veil that can be ignored because it's just a means used for transacting real goods, and it's the real resources in the economy. They're the interesting things, and money are just things that can be added on and subtracted. And of course, that is highly convenient for bankers to be left in the dark like that. And we may well ask, have there been any cases of shared interests between economists or finance experts and bankers that have promoted this silence on money? In fact, we may call this a major failing on the part of scholars, because bankers are practical people and they of course use extant concepts just like the public does. But finance scholars and economists, they should have updated the theory from the original warehouse banking theory to the credit creation theory. They should have done that ages ago and reconceptualized, found new concepts with which to understand banking. And I give you here a famous Nobel Prize winning economist, Paul Krugman, who, as you will find from the web address given below his picture, he engaged in a debate with the heterodox economist Steve Keen about the role of banks, and Krugman revealed that he understands next to nothing about what banks actually do when they lend money. Quite shocking, but that is the case with many top economists. They don't know about banks' money creation. Now let me conclude. Lending and other terminology seems to be hidden behind a veil. We don't really know what's going on in banks. It's not the classical veil of neutrality that money has usually been seen as, but it seems like maybe a veil of deception that's at least suggested by Norbert Herring, a German financial journalist who has written this very provocative paper that I refer to. Now, we looked at the three banking systems and we see that, well, they overlap, as do the three models of lending. They were, one, the warehouse theory, which legitimizes the charging of interest and glorifies banks' role in society. There was the second theory, in which banks are seen as having gold reserves and engaged in fractional reserve banking. And there was the third theory, which we found to have the best fit today, the theory that banks add to the money supply when lending. They actually engage in money creation. Now, we may argue that it's the responsibility of academics in critical finance to address this issue, because it really matters. Business cycles concentrate wealth at the top and deprive millions of their just share. And if we don't understand this causal factor, bubbles will return. The nature of bank lending needs to be clear. Banks' money creation feeds bubbles and crises. They're a major causal agent behind the roller coaster up and down economy that we have. If banking and monetary scholars realize this, they can help design a more equitable monetary system, one which controls bank credit creation or even strips banks of their power to create money, as has been suggested by some of these good people in the references to which I refer the listener if he or she wants to pursue this matter further. Here are the references, and this concludes my presentation. Thank you for your attention.